Imagine waking up one day and realizing that everything you thought you knew about money was wrong. That's exactly what happened to Sarah, a 25-year-old buried in student debt and barely making ends meet. In this video, we'll follow Sarah's journey as she uncovers 7 shocking truths about wealth that turned her financial life upside down. You'll see how she went from financial stress to building real wealth in just 18 months. Want to know her secrets? Keep watching. The high income illusion. Sarah's first job out of college seemed like a dream come true. She landed a position with an impressive title at a well-known company, and she couldn't wait to start building her wealth. But reality hit hard when she realized her fancy job barely covered her rent and student loan payments. Sound familiar? Like many of us, Sarah fell into the trap of the high income illusion. She believed that a big salary was the key to financial success. So she kept waiting for that next promotion or raise, thinking it would finally give her the means to start saving and investing. But here's the thing. While she was focused on climbing the corporate ladder, she was missing out on other opportunities to grow her wealth. Let's take a closer look at why income isn't everything when it comes to building wealth. You might be surprised to learn that many millionaires never earned huge salaries. In fact, a study by Thomas J. Stanley, author of The Millionaire Next Door, found that only 20% of millionaires are retirees. The other 80% made their fortune in ordinary industries and lived well below their means. So what's the secret? It's not about how much you make, but how much you keep and grow. Let's break down the math. Imagine 2 people, Alex, who earns $100,000 a year but spends it all, and Jamie, who earns $50,000 but saves and invests 20% of her income. After 10 years, Alex has nothing saved, while Jamie has over $150,000, assuming a 7% annual return on her investments. This example shows how small investors can actually outperform high earners over time. It's all about the power of compound interest and consistent saving. Even small amounts, when invested regularly, can grow into significant wealth over the long term. Sarah's light bulb moment came when she realized she had more control over her spending than her salary. She started looking at her expenses with a critical eye, finding ways to cut back without feeling deprived. She discovered that by reducing her rent by moving to a slightly smaller apartment and cutting back on eating out, she could free up $500 a month to invest. This shift in mindset was a game changer for Sarah. Instead of waiting for a bigger paycheck, she focused on maximizing the money she already had. She started educating herself about investing and opened a low-cost index fund account. Even though her salary hadn't changed, she was now on the path to building wealth. But what about those high-income earners? Surely they have an advantage, right? Not necessarily. High earners often fall into the trap of lifestyle inflation. As their income grows, so do their expenses. They buy bigger houses, fancier cars, and take more expensive vacations. Before they know it, they're living paycheck to paycheck, just like someone earning much less. This is why you'll often hear stories of teachers, nurses, or small business owners who retire as millionaires. They understand that wealth isn't about flashy possessions or a big salary. It's about making smart choices with the money you have, no matter how much that is. Let's look at another example. Meet Lisa, a school teacher earning $45,000 a year. She lives in a modest home, drives a reliable but not fancy car, and takes simple vacations, but she consistently invests 15% of her income and has been doing so for 25 years. With average market returns, she could have over $600,000 saved for retirement. Compare that to Mark, a lawyer earning $200,000 a year, but living an expensive lifestyle and only saving 5% of his income. After the same 25 years, he might have less saved than Lisa, despite earning 4 times as much. This isn't to say that increasing your income isn't important. Of course, earning more can give you more opportunities to save and invest. But the key is to focus on growing the gap between what you earn and what you spend, regardless of your income level. Sarah's journey taught her that financial freedom isn't about chasing a magic salary number. It's about making intentional choices with your money, living below your means, and consistently investing for the future. She learned to see money as a tool for building wealth, not just a means to buy things. The emotional spending trap. Sarah thought she had her spending under control, but her bank statement told a different story. What hidden force was sabotaging her best financial intentions? The answer might be hiding in your own wallet too. Let's talk about emotional spending. You know that feeling when you've had a rough day and suddenly that cute dress in the shop window seems like the perfect pick-me-up? Or maybe you found yourself clicking add to cart a little too enthusiastically after a stressful work week. Well, you're not alone. Sarah's closet was bursting with evidence of this all-too-human habit. Emotional spending happens when we make purchases driven by our feelings rather than actual need. It's like using shopping as a band-aid for our emotions. The problem is, while it might make us feel better in the moment, it can lead to some pretty unsustainable financial habits in the long run. Sarah decided to take a closer look at her spending habits. She tracked every purchase for a month, and the results were eye-opening. Those little treats to boost her mood added up to a significant chunk of her budget. She realized that a lot of her impulse buys were tied to stress from her job or arguments with friends. Here's the thing. Companies know all about our tendency to shop with our hearts instead of our heads. They're experts at using advertising to target our emotions and get us to open our wallets. Think about all those commercials that show people living their best lives after buying a certain product. They're not just selling stuff, they're selling feelings, happiness, confidence, belonging, and we often buy into it without even realizing. But there are healthier ways to deal with stress that don't cost a dime. Sarah started exploring alternatives to retail therapy. She found that going for a run, calling a friend, or even just taking a few deep breaths could help her manage difficult emotions without reaching for her credit card. Sarah's turning point came when she added up how much debt was tied to her emotional purchases. It was a wake-up call that made her realize she needed to make a change. She started implementing some simple tricks to pause before making impulse buys. One strategy that worked well for Sarah was the cooling-off period. Whenever she felt the urge to buy something that wasn't on her planned shopping list, she'd wait 24 hours before making the purchase. This gave her time to think about whether she really needed the item or if she was just trying to soothe her emotions. Another help trick was to practice delayed gratification. Instead of buying something right away, Sarah would add it to a wish list. Often, she found that after a few days or weeks, the urge to buy had passed. This not only saved her money, but also helped her distinguish between things she truly wanted and fleeting desires. Setting clear financial goals was another game changer for Sarah. By focusing on her long-term objectives like saving for a down payment on a house, she found it easier to resist impulsive purchases. She created a budget that aligned with her goals, which helped her prioritize her spending and make more intentional choices with her money. As Sarah worked on curbing her emotional spending, she also started paying more attention to her financial decision-making process. She realized that sometimes her choices were influenced by cognitive biases rather than logic. For example, she noticed she often fell for the anchoring effect, where the first price she saw for an item became a reference point, making higher prices seem more reasonable. Becoming aware of these mental shortcuts helped Sarah make more rational financial decisions. She started questioning her initial reactions to prices and deals, asking herself if she was really getting good value or just falling for clever marketing tactics. One of the most powerful tools Sarah discovered was simply acknowledging her emotions. By recognizing when she was feeling stressed, lonely, or anxious, she could address those feelings directly instead of trying to shop them away. This emotional awareness became crucial for her financial well-being. Sarah's journey to overcome emotional spending wasn't always easy. There were setbacks and moments of temptation. But with each small victory, she felt more in control of her finances and her emotions. She learned that true financial freedom isn't just about how much money you have. It's about having a healthy relationship with money. The financial advisor myth. Sarah's newfound financial confidence led her to explore investment options. But as she dug deeper, she uncovered a surprising truth about financial advisors that made her question everything. The common wisdom says you need a pro to manage your money. But is that really true? Let's talk about what financial advisors actually do and what they charge. Many advisors charge around 1% of the assets they manage for you each year. That might not sound like much, but think about it. If you have $100,000 invested, that's $1,000 every single year. And as your investments grow, so does that fee. Here's the thing, those fees can really add up over time. Sarah was shocked when she realized how much of her potential earnings could be eaten up by advisor fees. She started wondering if there was a better way. Now, don't get me wrong, financial advisors can be helpful, especially during big life changes like retirement or getting an inheritance. That's when you might need some complex financial planning. But for everyday investing, many people can do just fine on their own with a little education and discipline. Sarah learned about something called fiduciaries. These are advisors who are legally required to act in your best interest. Sounds good, right? But here's the kicker. Only about 20% of financial advisors are actually fiduciaries. That means most advisors aren't legally obligated to put your interests first. Pretty eye-opening, isn't it? Let's talk about investment performance. You might think that professional advisors would always get better results than regular folks managing their own money. But studies show that's not always the case. In fact, research by the National Bureau of Economic Research found that self-managed investment portfolios often do better than those managed by advisors, especially when the advisors aren't fiduciaries. So what does this mean for you? Well, it doesn't mean you should never use a financial advisor. But it does mean you should think carefully about whether you really need one for your situation. Sarah started looking into simple, low-cost investment options for beginners. She learned about index funds and ETFs. These are investments that track a whole market or sector instead of trying to pick individual stocks. They usually have much lower fees than actively managed funds, which means more of your money stays in your pocket. She also discovered automated investment platforms, sometimes called robo-advisors. These services use computer algorithms to manage your investments, and they typically charge much lower fees than human advisors, around 0.25% per year instead of 1%. For someone just starting out, that can be a smart money move. But here's an important point. Whether you decide to use an advisor or go it alone, you need to understand the basics of investing. Financial literacy is key. Even if someone else is managing your money, you need to know enough to ask the right questions and make informed decisions. Sarah realized she could learn to manage her own finances. She started reading books, watching educational videos, and even took some online courses about investing. It wasn't always easy, but she found that the more she learned, the more confident she felt about making her own financial decisions. Now, you might be wondering, when does it make sense to hire a financial advisor? Well, if you're dealing with a complicated financial situation like figuring out how to manage a large inheritance or planning for retirement, an advisor can be really helpful. They can also be great if you're going through a major life change, like getting married or starting a business. But for many young investors like Sarah, DIY money management can be just as effective as hiring a pro. By learning to manage her own investments, Sarah could potentially save thousands of dollars in fees over her lifetime. Plus, she felt empowered, knowing she was in control of her financial future. The work more hours trap. Sarah felt proud of her work ethic, often putting in long hours at the office. She believed that the more time she spent working, the faster she'd climb the ladder to wealth. But here's the thing. What if working longer hours wasn't actually the key to financial success? Let's talk about a mindset shift that could change everything. You see, there's a big difference between active income and passive income. Active income is what you earn by trading your time for money, like your regular job. Passive income, on the other hand, is money that keeps coming in even when you're not actively working. Think rental properties, investments, or online businesses that run themselves. Now, you might be thinking, sure, passive income sounds great, but I need to work hard to make money right now. And you're not wrong. Hard work is important. But here's where things get interesting. Working smarter can actually lead to greater wealth than simply working harder. Consider this. Research shows that the traditional 40-hour workweek is a relatively new concept, coming about after the Industrial Revolution. Many of us still stick to this outdated standard, even though studies suggest that productivity doesn't necessarily increase with longer hours. In fact, working more than 60 hours a week can actually lead to diminishing returns in productivity. Think about it. Have you ever noticed how the last hour or two of a long workday feel less productive? That's the law of diminishing returns in action. After a certain point, each additional hour you work doesn't give you the same bang for your buck in terms of output. It's like trying to squeeze the last bit of toothpaste out of the tube. You're putting in a lot of effort for not much reward. Here's something that might surprise you. Many successful people actually work fewer hours but make more money. How do they do it? They focus on efficiency and creating value, not just clocking in hours. They prioritize high-value tasks and look for ways to leverage their time and skills. For example, instead of working overtime at their day job, they might spend those extra hours learning new skills, starting a side business, or researching investment opportunities. These activities have the potential to create passive income streams or increase their earning power in the long run. But let's be real. Constant overwork isn't just bad for your productivity, it's also terrible for your health. Studies show that companies lose up to $300 billion annually due to workplace stress. This includes costs related to absenteeism, turnover, and reduced productivity. So not only are you potentially earning less by overworking, you're also putting your health at risk. So what's the alternative? Instead of just working more hours, focus on increasing your value per hour. This might mean investing in your education, learning new skills, or finding ways to be more efficient in your current role. By becoming more valuable, you can earn more without necessarily working longer hours. For Sarah, this was a game changer. She realized that instead of staying late at the office every night, she could use that time to learn about investing, improve her coding skills, or even start a small online business. These activities had the potential to increase her earning power and create new income streams without requiring her to work around the clock. Think about your own situation. Are there skills you could learn that would make you more valuable in your current job? Could you start a side project that might generate passive income in the future? Remember, it's not about working yourself to the bone. It's about making smart choices with your time and energy. Many successful individuals advocate for a balanced approach to work. They emphasize the importance of investing in skills and personal development rather than simply increasing hours worked. This doesn't mean slacking off. It means being strategic about how you use your time and energy. For Sarah, this meant setting aside time each week for learning and personal development. She started taking online courses in financial management and digital marketing. She also began exploring ways to turn her hobby, creating handmade jewelry, into a small side business that could generate passive income. The payoff? Working more hours isn't always the answer. By focusing on increasing your value and creating passive income streams, you can potentially earn the big house blunder. Let's talk about a big financial myth that's been tripping up a lot of people, especially young professionals like Sarah. You know that dream of owning a big, beautiful house? The one with the perfect kitchen, the spacious rooms, and maybe even a pool in the backyard? Well, it turns out that dream might actually be more of a financial nightmare. Sarah, like many of us, always thought a big house was a sign that you've made it. It's what we see in movies, on TV, and all over social media. But here's the thing. That big house might actually be holding you back from building real wealth. Think about it. When you buy a house, it's not just the mortgage you're dealing with. There are property taxes, insurance, maintenance costs, and don't even get me started on the energy bills for heating and cooling all that space. All these expenses can add up quickly, leaving you with less money to invest or save for other goals. This is where the concept of being house poor comes in. It's a term you might not have heard before, but it's something that affects a lot of homeowners. Being house poor means you're spending so much on your home that you don't have much left for other important things in your life. And get this. According to a recent Consumer Affairs survey, More than half of homeowners say their housing expenses are their biggest financial burden. Even worse, 40% of them admit these expenses are more than they can actually afford. Now you might be thinking, but isn't a house an investment? Well, yes and no. While property can appreciate over time, it's not always the sure bet people think it is. Plus, when you tie up so much of your money in your house, you're missing out on other opportunities to grow your wealth. Let's break it down with some numbers. Imagine you decide to buy a smaller, more affordable home instead of stretching your budget for that dream house. You could potentially free up hundreds or even thousands of dollars each month. Now, what if you took that extra money and invested it? Over time, those investments could grow significantly, potentially outpacing the appreciation of a larger home. But here's where it gets really interesting. Many Americans feel pressured to buy bigger homes than they actually need. It's like we're all trying to keep up with the Joneses, prioritizing appearances over financial health. But what if we flip that script? Downsizing or choosing a smaller home from the start can be a smart money move. It's not about living in a tiny house, unless that's your thing. It's about finding a comfortable home that meets your needs without breaking the bank. The money you save can then be redirected into investments, potentially leading to greater wealth accumulation over time. Sarah was surprised to learn about all this. She always thought a big house was a sign of wealth, but now she was seeing how it could actually lead to financial instability. It was a real eye-opener for her to realize that owning a large house might limit her ability to invest in other wealth-building opportunities. So, what are some alternatives to buying a big house that can actually help build more wealth? Well, there are quite a few options to consider. You could rent a modest apartment and invest the difference, or buy a smaller home in an up-and-coming neighborhood. Some people even choose to purchase a duplex, living in one unit and renting out the other to help cover the mortgage. The key is to shift your perspective. Instead of seeing your home primarily as an investment, think of it as what it really is: a place to live. Yes, it's important, and yes, it should be comfortable, but it doesn't need to be a showpiece that eats up all your resources. You might be shocked to hear how much money you could potentially invest with the savings from a smaller home. Let's say you opt for a home that costs $200,000 less than that big dream house. If you invested the difference in mortgage payments, let's estimate around $1,000 a month over 30 years, assuming an average annual return of 7%, you could end up with over $1.2 million. That's a pretty significant nest egg, all from choosing a more modest home. Case studies have shown that individuals who have downsized their homes have been able to increase their overall wealth by reallocating the savings from lower housing costs into investments. It's not just about the immediate savings, it's about the long-term growth potential of that money when it's put to work in the market instead of tied up in excess square footage. For Sarah, this realization was a game changer. She started to see that a smaller home could actually mean bigger opportunities for building real wealth. It wasn't about giving up on her dreams, but rather refocusing them on financial freedom instead of square footage. The savings account fallacy. Sarah's journey to financial wisdom was just beginning. As she rethought her housing plans, another money myth was lurking in her bank account. Is your savings account really as safe as you think? The truth might surprise you and make you rethink where you keep your hard-earned cash. Let's talk about something we've all heard since we were kids. Save your money. It's solid advice, right? Well, yes and no. Saving is important, but here's the thing. Your trusty savings account might not be the financial superhero you think it is. In fact, it could be your wealth's worst enemy. Think about it. When was the last time you checked the interest rate on your savings account? If you're like most people, you probably haven't given it much thought. But here's a shocking fact. As of 2023, the average savings account interest rate in the US is only about 0.05%. That's right, just 0.5%. Now, you might be thinking, okay, that's not great, but at least my money is safe and growing a little bit. But hold on a second. Let's compare that tiny interest rate to something else. Inflation. Currently, inflation is sitting at around 3.7%. See the problem? Your money isn't just growing slowly, it's actually losing value over time. Imagine you have $1,000 in your savings account. After a year, you'll have earned a whopping 50 cents in interest. Meanwhile, the things you want to buy have gotten about 3.7% more expensive. Your money is literally worth less than when you put it in the bank. It's like having a bucket with a tiny hole in it. Sure, you're adding water, but you're losing more than you're gaining. This is the savings account fallacy that Sarah discovered. She had always thought that keeping her money in a savings account was the responsible thing to do. But when she looked at the numbers, she realized her safe strategy was actually costing her money in the long run. So what's the solution? Should we just stuff our cash under our mattresses? Of course not. The key is to find a balance between saving and investing. You see, while saving is great for short-term goals and emergencies, investing is what helps you build wealth over time. Financial experts recommend keeping an emergency fund that covers 3 to 6 months of living expenses in a readily accessible account. This is your safety net, and it's super important. But beyond that, it's time to think about making your money work harder for you. Here's where investing comes in. Now, I know the word investing might sound scary or complicated, but it doesn't have to be. There are plenty of simple, low-risk ways to start investing that can help your money grow faster than inflation. For example, many financial analysts suggest that the average American should aim to invest at least 15% of their income. This isn't just for the wealthy. It's a strategy that can help anyone build a substantial retirement fund over time. Sarah was surprised to learn about index funds and exchange-traded funds, ETFs. These are types of investments that track entire markets or sectors and usually have lower warrant fees than actively managed funds. They're a great way for beginners to dip their toes into investing without needing to become a Wall Street expert overnight. Now, you might be wondering, but isn't investing risky? And you're right to ask that question. All investments carry some level of risk. But here's the thing, not investing is risky too. Remember that inflation we talked about? That's a risk to your savings that's guaranteed to happen. The trick is to find a balance that works for you. Maybe you start small, investing just a little bit each month. As you get more comfortable and learn more, you can adjust your strategy. The important thing is to start thinking about your money in a new way. For Sarah, this was a game changer. She realized that by keeping all her money in a savings account, she was actually falling behind financially without even realizing it. She started to see her money not just as something to be saved, but as a tool that could grow and work for her. Of course, this doesn't mean you should empty out your savings account tomorrow and throw it all into the stock market. Financial decisions should always be made carefully and with consideration of your personal situation. But it does mean that it's worth taking a closer look at where your money is and whether it's really working as hard as it could be. Think about your own finances. How much do you have sitting in a savings account right now? How much interest is it earning? And most importantly, what could that money be doing if you put it to work in a different way? The power of small investments. Sarah's eyes widened as she stumbled upon a game-changing idea. Could investing really be accessible to someone on a tight budget? The answer was about to change how she looked at her spare change forever. Let's talk about the power of small investments. You might think you need a big chunk of money to start investing, but that's not true at all. In fact, you can start building real wealth with less money than you spend on your morning coffee. It's all about consistency and starting early. Remember how we talked about the gap between what you earn and what you spend? Well, even if that gap is small, you can put it to work for you. Micro-investing apps have become super popular lately, and for good reason. They make it easy for anyone to start investing, even if you only have a few bucks to spare. Think about apps like Acorns and Stash. These clever little tools let you invest your spare change from everyday purchases. So when you buy that 3 and 50 latte, the app might round up to $4 and invest that 50 cents for you. It doesn't sound like much, but it adds up fast. And get this, Acorns reported over 9 million users in 2021. That's a lot of people realizing they can start small and still make a big impact on their financial future. Now, let's talk about the magic of compound interest. Einstein supposedly called it the eighth wonder of the world, and he wasn't kidding. When you invest, even small amounts, that money has the potential to grow over time. And then the interest you earn starts earning interest too. It's like a snowball rolling down a hill, getting bigger and bigger. Here's a mind-blowing example. If you invest just $5 a day for 30 years and you get an average return of 7%, which is pretty standard for long-term stock market returns, you could end up with over $200,000. That's the power of starting small and being consistent. Sarah was amazed when she ran the numbers. She realized that by skipping her daily store-bought coffee and packing lunch a few times a week, she could easily free up $5 a day to invest. It wasn't about depriving herself. It was about making smart choices with her money. But here's the thing. It's not just about the amount you invest. It's also about when you start. The earlier you begin, the more time your money has to grow through compound interest. That's why it's so important to start investing as soon as possible, even if you can only spare a few dollars at a time. Sarah had always thought investing was something she'd do someday when she had more money. But now she realized she didn't have to wait. She could start building her wealth today, not someday. This was a huge breakthrough for her. Think about it. How many times have you told yourself you'll start saving or investing when you get a raise, or when you pay off your debt, or when you have more money? But the truth is, there's never going to be a perfect time. The best time to start is now, with whatever you can afford. You might be surprised to learn how many millionaires built their wealth through small, regular investments. It's not about making one big, lucky investment. It's about consistently putting money aside and letting it grow over time. That's how real, sustainable wealth is built. Sarah started looking for ways to make investing a regular habit. She set up automatic transfers from her checking account to her investment account every payday. She downloaded a micro-investing app and started rounding up her purchases. She even started a challenge with her friends to see who could save the most in spare change over a month. The key is to make it easy and automatic. When you don't have to think about it, you're more likely to stick with it. And over time, those small investments can add up to something really significant. Now, this doesn't mean you should invest money you can't afford to lose. It's still important to have an emergency fund and pay off high-interest debt. But once you've got those basics covered, even small investments can be a powerful tool for building wealth. The money-happiness equation. Sarah's journey of financial discovery had been eye-opening, but she was about to face a truth that would challenge everything she thought she knew about money and happiness. She'd always believed that if she could just make more money, all her problems would be solved. But was it really that simple? Let's talk about what researchers have found when it comes to money and life satisfaction. It turns out the relationship between cash and contentment isn't as straightforward as we might think. In fact, there's this thing called the hedonic treadmill that might just flip your world upside down. Think about it like this. Have you ever gotten a raise or bought something you really wanted, only to find that the excitement wore off pretty quickly? That's the hedonic treadmill in action. As we get more money or stuff, our expectations and desires tend to increase right along with them. Before we know it, we're back to our baseline level of happiness, always chasing the next big thing. Here's where it gets really interesting. Studies have shown that there's actually a magic number when it comes to income and happiness. Now, don't get too excited. It's not about becoming a millionaire. The number that keeps popping up in research is around $75,000 per year. That's the point where people tend to feel pretty satisfied with their lives. Beyond that, more money doesn't seem to have much impact on day-to-day happiness. But wait, there's more to the story. It's not just about how much money you have, it's about how you use it. Sarah was intrigued to learn that experiences often bring more lasting happiness than material purchases. Think about it. That vacation you took with friends or that concert you went to, those memories stick with you and bring a smile to your face long after the trip is over. On the other hand, That new gadget or designer bag? The thrill often fades pretty quickly. Now you might be thinking, okay, but surely being wealthy would solve all my problems, right? Well, not so fast. Wealth can actually come with its own set of stresses and anxieties. Imagine constantly worrying about managing your money, dealing with people who might want to take advantage of you, or feeling pressure to maintain a certain lifestyle. It's not always the carefree existence we might imagine. So, what's the secret to using money in a way that actually boosts happiness? It's all about aligning your spending with your values. When you use your money in ways that reflect what's truly important to you, whether that's supporting causes you care about, investing in personal growth, or creating meaningful experiences with loved ones, that's when you're likely to see a real impact on your well-being. Sarah had a light bulb moment when she realized this. Money wasn't the end goal. It was a tool for creating a good life. She started thinking about what really mattered to her and how she could use her resources to support those priorities. Maybe it was setting aside money for a creative hobby she'd always wanted to pursue, or planning a trip to reconnect with old friends. The big takeaway? More money doesn't always equal more happiness. It's how you use it that counts. When Sarah understood this, she felt a weight lift off her shoulders. She no longer felt the need to constantly chase a bigger paycheck or compare herself to others who seemed to have more. Instead, she could focus on using her money in ways that truly enhanced her life and the lives of those around her. But Sarah's journey wasn't over yet. Now that she had a clearer perspective on the relationship between money and happiness, she was ready to face one of her biggest financial fears. And let me tell you, what she discovered next would change everything. Overcoming financial fear. Have you ever felt a knot in your stomach when thinking about your finances? You're not alone. Sarah was about to confront a fear that's incredibly common, yet rarely talked about. And what she discovered might just change the way you think about money forever. Let's face it, financial anxiety is real, and it can seriously mess with our money decisions. When we're scared, we often make choices that aren't in our best interest. Maybe we avoid looking at our bank statements, put off investing, or make impulsive purchases to feel better in the moment. Sound familiar? Sarah realized her fear of making money mistakes was holding her back big time. She'd avoid making important financial decisions, worried she'd mess up and lose everything. But here's the thing. By not making any moves, she was actually missing out on opportunities to grow her wealth. So where do these money fears come from? Often, they're rooted in our childhood experiences, or things we've heard from friends and family. Maybe you grew up in a household where money was tight, or you've heard horror stories about people losing their savings in the stock market. These experiences can shape our beliefs about money and make us overly cautious. But here's a comforting truth Sarah discovered. Even financial experts make mistakes sometimes. Yep, you heard that right. The pros don't always get it perfect either. This realization was a game changer for Sarah. It helped her see that making a mistake doesn't mean you're bad with money. It's just part of the learning process. So how can we build financial confidence? It's not about becoming fearless overnight. It's about taking small steps and gradually increasing our comfort with money matters. Sarah started by setting clear, achievable financial goals. Instead of thinking, I need to be rich, she focused on specific targets like saving $1,000 for an emergency fund or increasing her 401k contribution by 1%. Another strategy that helped Sarah was practicing delayed gratification. When she felt the urge to make an impulse purchase, she'd add the item to a wish list instead of buying it right away. This gave her time to think about whether she really needed it, and often the urge to buy would pass. Developing self-discipline with spending habits was also key. Sarah started tracking her expenses and creating a budget. It wasn't always fun, but it gave her a sense of control over her finances that began to outweigh her fear. You might be surprised to hear how many opportunities fear causes people to miss out on. Sarah learned that many individuals are so paralyzed by the anxiety of making money mistakes that they never start investing or pursuing better-paying jobs. This fear can cost us thousands, even millions, over a lifetime. One of the biggest challenges Sarah faced was separating her emotional reactions from financial decisions. We often make choices based on fear or excitement rather than logic. For example, selling investments in a panic when the market dips, or splurging on a luxury item to celebrate a promotion. Sarah learned to pause and ask herself, am I making this decision based on facts or feelings? The turning point for Sarah came when she realized that some fear is normal, but it shouldn't paralyze her. It's okay to be cautious with your money, but not to the point where you're missing out on growth opportunities. She started to see fear as a signal to learn more about a financial topic, rather than a reason to avoid it altogether. One powerful strategy Sarah used to overcome her financial anxiety was stress management. She created a budget and started building an emergency fund. Having this financial cushion helped alleviate some of her worries and improved her decision-making. When you're not constantly stressed about money, it's easier to make rational choices. Sarah also learned about loss aversion, our tendency to prefer avoiding losses over acquiring equivalent gains. This explained why she was so hesitant to invest, even though she knew logically that investing was crucial for long-term wealth building. Understanding this bias helped her challenge her fear-based thinking. As Sarah faced her financial fears, she discovered a world of opportunities she'd been missing out on. She started investing small amounts in index funds, volunteered to lead a project at work that came with a bonus, and even started a side hustle selling handmade jewelry online. Eat the Money Mindset Makeover. Sarah's journey to financial confidence took an unexpected turn when she discovered the power of her money mindset. As her small wins added up, she began to notice something interesting. Her thoughts about money were actually shaping her financial reality. It was like she'd stumbled upon a hidden superpower she never knew she had. Let's talk about how our mindset can make or break our financial success. It turns out, the way we think about money isn't just random. Our childhood experiences, the things we heard our parents say about money, and even the financial stories we picked up from friends and family all come together to form our adult money beliefs. Sarah was fascinated to learn about different money personalities and couldn't wait to figure out which one she had. There are actually 4 main types: money avoidance, money worship, money status, and money vigilance. Each of these shapes how we interact with our finances in unique ways. For example, someone with money avoidance might feel anxious about having money and think rich people are greedy. This can lead to self-sabotage in financial situations. On the flip side, those with money worship might believe more money will solve all their problems, leading to impulsive spending or even gambling. Money status folks see wealth as a measure of social standing. They might overspend to keep up appearances, even if it puts them in financial trouble. And then there's money vigilance. These are the super frugal types who might be secretive about their finances. While being careful with money isn't bad, this mindset can sometimes lead to missed opportunities for smart investments. Sarah realized she had a bit of money avoidance mixed with some money worship tendencies. She often felt uncomfortable thinking about money and sometimes splurged on unnecessary items, hoping they'd make her feel better. But here's the thing. Recognizing these patterns was the first step to changing them. There are some simple exercises you can try to identify and change limiting money beliefs. One is journaling about your financial experiences. Sarah started writing down her thoughts about money every day, and it helped her spot patterns she'd never noticed before. Another great exercise is visualizing your financial goals. Sarah spent time imagining what her life would look like if she achieved financial freedom, and it motivated her to make better choices. You might be surprised to hear how successful people often think differently about money. Many of them have what's called a growth-oriented mindset. Instead of seeing financial challenges as obstacles, they view them as opportunities to learn and grow. This shift in perspective can make a huge difference in how you handle money matters. Sarah also learned about the importance of surrounding yourself with positive financial influences. She started seeking out mentors who had achieved the kind of financial success she wanted. She joined online communities where people shared tips and encouragement for managing money better. It's amazing how much easier it is to stay motivated when you're not going it alone. As Sarah dug deeper into the psychology of money, she discovered some interesting concepts. One that really stood out was the idea of cognitive biases. These are mental shortcuts our brains take that can sometimes lead us astray with our finances. For instance, there's confirmation bias, where we tend to seek out information that confirms what we already believe about money. And then there's the anchoring effect, where we rely too heavily on the first piece of information we receive when making financial decisions. Understanding these biases helped Sarah become more aware of her own thought patterns. She started questioning her assumptions about money and became more open to new ideas and strategies. Another game changer for Sarah was learning about the quadrupit theory. This concept emphasizes the importance of balancing physical, mental, spiritual, and financial health for overall well-being. Sarah realized that her financial stress was impacting other areas of her life, and vice versa. By working on all these aspects together, she felt more balanced and in control. Sarah's biggest breakthrough came when she realized she had the power to change her money story. She didn't have to be stuck with the beliefs and habits she'd picked up over the years. With effort and practice, she could rewrite her financial narrative. She started setting smart financial goals: specific, measurable, achievable, relevant, and time-bound. This gave her a clear roadmap to follow. She also worked on cultivating positive financial habits, like tracking her expenses and setting aside money for savings before spending on non-essentials. One of the most challenging but rewarding changes Sarah made was practicing delayed gratification. Instead of buying things on impulse, she'd add them to a wish list and wait. Often, she found that after a few days, she didn't even want the item anymore. This simple practice helped her save money and make more thoughtful purchasing decisions. The all debt is bad myth. Sarah's journey to financial confidence took an unexpected turn when she stumbled upon a concept that challenged everything she thought she knew about money. You might think all debt is bad news, but what if I told you some types of debt could actually help you grow your wealth? Let's dive into a financial concept that might surprise you. For years, Sarah had been taught that debt was something to avoid at all costs. She'd hear phrases like, "stay out of debt," and "debt-free is the way to be," thrown around like confetti at a New Year's party. But as she dug deeper into her financial education, she discovered that not all debt is created equal. In fact, some types of debt can be powerful tools for building wealth when used wisely. Here's the thing. There's a big difference between what financial experts call good debt and bad debt. Good debt typically includes loans that can help you generate income or increase in value over time. On the other hand, bad debt often refers to high-interest consumer debt, like credit card balances that keep piling up. Let's talk about a classic example of good debt, a mortgage. When Sarah first heard this, she was skeptical. How could owing hundreds of thousands of dollars on a house be a good thing? But as she learned more, it started to make sense. When you take out a mortgage to buy a home, you're not just getting a place to live, you're also building equity over time. Think about it this way. If you buy a home for $100,000 with a 20% down payment, and the home's value goes up to $120,000 after 5 years, you've essentially gained $20,000 in equity. That's like 100% return on your initial $20,000 investment. Plus, unlike renting, where your monthly payments just disappear into your landlord's pocket, mortgage payments are a form of forced savings. You're building ownership in a valuable asset with each payment. Another type of debt that often gets a bad rap is student loans. Sure, the idea of graduating with a mountain of debt can be scary. But here's another way to look at it. Student loans can be an investment in your future earning potential. By getting a degree or advanced training, you're opening doors to higher-paying jobs and career opportunities that might not be available otherwise. Now, this doesn't mean you should take on massive student loans without thinking it through. It's important to consider the potential return on investment. Will your chosen field of study lead to a career that can comfortably support loan repayments? That's a crucial question to ask before signing on the dotted line. Sarah was surprised to learn that even successful businesses use debt as a tool for growth. Many entrepreneurs take out loans to fund business expansion, buy inventory, or invest in new equipment. When managed properly, this kind of debt can lead to significant returns on investment. It's all about using borrowed money to generate more income than the cost of the debt itself. Here's a mind-bending concept that really got Sarah thinking. Wealthy individuals often use debt strategically to increase their wealth even faster. They might take out loans to finance investments that yield higher returns than the cost of the debt. This strategy allows them to grow their wealth more quickly than if they only use their own money. It's like using other people's money to make yourself richer. But before you rush out to take on debt left and right, there's an important catch. Understanding the terms and interest rates associated with any debt is crucial. A mortgage might have a lower interest rate compared to credit card debt, but you need to look at the long-term implications of each type of debt before making any decisions. Sarah realized that smart debt management could be a powerful tool for financial growth. Instead of avoiding debt entirely, she started to see it as something that could be leveraged when used wisely. She began to ask herself questions like, will this debt help me increase my income or build wealth in the long run? Can I comfortably manage the payments? What's the interest rate? And how does it compare to potential returns? By changing her perspective on debt, Sarah opened up new possibilities for her financial future. She started to consider how a mortgage could help her build equity instead of paying rent. She looked into how student loans could boost her earning potential in a field she was passionate about. And she even began exploring how she might use debt to start a small side business in the future. The too poor to invest trap. Sarah's journey to financial confidence took another exciting turn when she stumbled upon a game-changing realization. She had always thought investing was something only rich people could do. But what if I told you that waiting until you're wealthy enough to start investing is one of the biggest mistakes you can make? Let's talk about why you don't need to be rich to start building wealth. In fact, thanks to modern technology and innovative financial platforms, you can begin your investing journey with less money than you probably spent on coffee this week. Think about it. How much spare change do you have lying around? Those coins in your car's cup holder or the bottom of your purse could be the start of your investment portfolio. It might sound crazy, but it's true. Micro-investing apps have revolutionized the way we think about saving and investing. These clever tools allow you to invest your spare change from everyday purchases. So that $3.50 latte you bought, the app might round it up to $4 and invest that 50 cents for you. Now I know what you're thinking. How can 50 cents here and there make any real difference? But here's the thing. It's not just about the amount you invest. It's about starting early and being consistent. Remember, every investment journey begins with a single step, no matter how small. Let's break it down with some numbers. Imagine you're able to set aside just $5 a day for investing. That's less than the cost of a fancy coffee or a quick lunch out. Over 30 years, assuming an average annual return of 7%, which is in line with historical stock market performance, that daily $5 investment could grow to over $200,000. That's the power of compound interest working its magic. But what if you don't have $5 a day to spare? No problem. Many platforms now offer fractional shares, meaning you can buy a piece of a stock rather than a whole share. This opens up a world of possibilities for beginners who want to dip their toes into investing without a large upfront cost. And here's something that might surprise you. Some of the world's most successful investors started with very little. Take Warren Buffett, for example. He bought his first stock at age 11 with money he earned from his paper route. The lesson here? It's not about how much you start with, but how early you start and how consistently you invest. Now, I'm not saying you should rush out and start throwing money at random stocks. Smart investing is about education and strategy. Index funds and ETFs, exchange-traded funds, are great options for beginners. They provide broad market exposure and typically have lower fees than actively managed funds. This means you can start building a diversified portfolio even with a small amount of money. Sarah was amazed to learn about all these options. She realized that by cutting back on a few small expenses, she could free up money to start investing. She downloaded a micro-investing app and set it up to round up her purchases to the nearest dollar, investing the difference. She also decided to put $50 a month into a low-cost index fund. At first, it didn't feel like much, but as the weeks went by, Sarah watched her little investment account grow. She felt a sense of pride and accomplishment each time she checked her balance. More importantly, she felt empowered. She was no longer waiting for some magical day in the future when she'd be rich enough to invest. She was taking action now, building her financial future one small step at a time. The key takeaway here is that you don't need to wait until you have a huge sum of money to start investing. In fact, starting small and early can be a huge advantage. It gives you time to learn, make mistakes because we all do, and benefit from the power of compound interest. Remember, building wealth isn't about making one big dramatic move. It's about making consistent, smart choices over time. Every dollar you invest is a vote for your future self. And the sooner you start, the more time your money has to grow. Breaking free from financial comparisons. Have you ever caught yourself scrolling through social media, feeling a pang of envy at your friend's lavish vacation or a colleague's new car? You're not alone. Sarah found herself in this exact situation, constantly comparing her financial situation to others. But here's the thing, this habit was doing more harm than good. Let's talk about how social media can create a financial fantasy world. We see carefully curated posts showcasing luxurious lifestyles, expensive purchases, and seemingly perfect financial situations. It's easy to forget that what we see online is often just a highlight reel, not the full picture. Sarah realized she was measuring her financial success against an unrealistic standard, and it was affecting her confidence and decision-making. This brings us to a concept you might have heard of, keeping up the Joneses. It's the idea that we need to match or outdo our neighbors, or in today's world, our social media connections, in terms of material possessions and lifestyle. But here's the kicker. This mindset can lead to unnecessary spending and an unhealthy relationship with money. Think about it. When we're constantly trying to match someone else's lifestyle, we're not focusing on our own financial goals. We might overspend on things we don't really need or value just to keep up appearances. This can lead to debt, stress, and a feeling of never being satisfied with what we have. Sarah was relieved to learn that most people's financial lives aren't as perfect as they seem. In fact, there's often a significant gap between perceived and actual wealth. Many of us believe our peers are more financially successful than they really are, which can lead to feelings of inadequacy and anxiety. Comparing yourself to others can lead to some pretty poor financial decisions. You might be tempted to take on debt to fund a lifestyle you can't afford, or you might put off important financial goals like saving for retirement because you feel like you're behind compared to others. These choices can have long-lasting impacts on your financial health. Now, here's something that might surprise you. Have you heard of the millionaire next door phenomenon? It turns out that many wealthy individuals don't live lavish lifestyles or flaunt their wealth. Instead, they often live below their means and prioritize saving and investing over conspicuous consumption. This just goes to show that true financial success isn't always visible from the outside. So, how can we break free from these unhelpful comparisons? Financial experts suggest developing a personal benchmark for financial success. This means setting clear, achievable financial goals that align with your own values and lifestyle. Instead of trying to match someone else's financial journey, focus on what's important to you. For Sarah, this meant taking a step back and reassessing her priorities. She started by listing her own financial goals, things like building an emergency fund, paying off her student loans, and saving for a down payment on a house. By focusing on these personal objectives, she found it easier to ignore the noise of social media comparisons. Another strategy is to improve your financial literacy. Understanding financial principles can empower you to make informed decisions based on your own circumstances, rather than what you think others are doing. Sarah started reading personal finance books and following reputable financial education websites to boost her knowledge. It's also helpful to remember that everyone's financial journey is unique. Your circumstances, goals, and challenges are different from anyone else's. Instead of comparing yourself to others, try to learn from their experiences. If a friend seems to be doing well financially, ask them for advice or tips rather than feeling envious. Sarah's big realization was that her unique financial journey was more important than matching others' perceived success. She started celebrating her own financial wins, no matter how small. Paying off a credit card, sticking to her budget for a month, or increasing her savings rate, all became moments of pride. The multiple income streams secret. Sarah's journey through the world of personal finance had been eye-opening, but she was about to discover a game-changing concept that would revolutionize her approach to money. While celebrating her small financial wins, she stumbled upon an idea that could multiply those victories and accelerate her progress. The secret? It wasn't about working harder at her day job. It was about creating multiple streams of income. Like many of us, Sarah had always believed that a single job was the only way to earn money. But as she dug deeper into financial education, she realized that limiting herself to one income source was like putting all her eggs in one basket. It was time to explore the power of diversification in her earnings. Let's talk about the different types of income Sarah learned about. There's active income, which is what most of us are familiar with. The money we earn from our jobs. Then there's passive income, which continues to flow even when we're not actively working, like rental property income or royalties from a book. And finally, there's portfolio income, which comes from investments like stocks or bonds. The idea of creating multiple income streams might sound overwhelming at first, but Sarah discovered it didn't have to be. She started by looking at her skills and interests, wondering if any of them could be turned into a side hustle. Maybe you've got a knack for graphic design, or you're a whiz at organizing spaces. These talents could be the foundation for a freelance business or a part-time gig. Think about it. In today's gig economy, there are countless opportunities to monetize your time and skills flexibly. Platforms like Uber, Etsy, and Upwork have made it easier than ever to dip your toes into entrepreneurship without quitting your day job. Sarah was intrigued by the idea of freelance writing, something she could do in her spare time without interfering with her regular work schedule. But side hustles aren't the only way to diversify your income. Sarah learned about the power of investing in dividend-paying stocks, which could provide a steady stream of income while her investments grew over time. She also discovered the potential of real estate investing, even on a small scale. One case study that caught her attention was about someone who bought a condo for just $8,000 during the 2008 market crash and rented it out for $600 a month. This example showed Sarah how even a modest investment could lead to significant passive income. Here's the thing that really got Sarah's attention. According to a 65% of millionaires have 3 or more income streams, and 45% have 4 or more. This statistic was a wake-up call. It showed that diversifying income sources wasn't just a trend. It was a common strategy among wealthy individuals. But why is having multiple income streams so important? For one, it provides financial security. If you lose your job or one income source dries up, you've got others to fall back on. It's like having multiple safety nets. Plus, with various streams of income, you can accelerate your savings and investment goals. Imagine being able to funnel the extra money from your side hustle directly into your retirement account or using it to pay off debt faster. Sarah was surprised to learn that creating multiple income streams isn't just for the wealthy or entrepreneurial types. A survey showed that 44% of Americans have a side hustle, with the most common reasons being to pay off debt, save for a vacation, or build an emergency fund. These are goals that resonate with many of us, right? As Sarah explored these ideas, she started to see opportunities everywhere. That blog she'd been thinking about starting? It could potentially be monetized through affiliate marketing and sponsorships. The coding skills she was learning in her spare time? They could lead to freelance web development projects. Even her hobby of making handmade jewelry could turn into an Etsy shop. The concept of multiple income streams isn't just about making more money, it's about creating financial resilience. In today's uncertain economic climate, relying on a single source of income can be risky. By diversifying, you're better prepared to weather financial storms and take advantage of new opportunities. For Sarah, this revelation was empowering. She realized that she had more control over her financial future than she'd previously thought. It wasn't about working longer hours at her day job. It was about working smarter and leveraging her skills and interests. Just when Sarah thought she had a handle on her finances, she discovered there was a whole other layer to explore. Have you ever wondered why you make the money decisions you do? It turns out, your unique money personality might be calling the shots, and understanding it could be a game changer for your financial future. Sarah had never considered the idea of having a money personality before. But as she dug deeper into her financial journey, she realized that her attitudes and behaviors towards money weren't just random. They were part of a larger pattern. This revelation opened up a whole new world of self-discovery for her. Let's talk about these money personalities. There are 4 main types: money avoidance, money worship, money status, and money vigilance. Each one reflects different attitudes and behaviors towards money, and they can have a big impact on how we handle our finances. Think about it. If you're someone who feels anxious about having money or believes that rich people are greedy, you might fall into the money avoidance category. This mindset can lead to some tricky behaviors, like giving away money when you shouldn't, or avoiding financial discussions altogether. On the flip side, if you see money as the key to happiness and believe that more cash will solve all your problems, you might be a money worshiper. This can lead to impulsive spending or even gambling. For those who equate their self-worth with their financial status, you might be in the money status camp. This often comes with a need to show off wealth through material possessions, which can lead to overspending. And if you're super cautious and frugal with your money, always prioritizing saving over spending, you might have a money vigilance personality. Sarah was fascinated to learn about these different types. As she read about each one, she started to recognize aspects of herself in more than one category. She realized she had tendencies of both money avoidance and money worship. This self-awareness was eye-opening for her. Here's the thing. Understanding your money personality isn't about labeling yourself as good or bad with money. It's about recognizing your natural tendencies so you can work with them instead of against them. Each personality type has its own strengths and weaknesses. For example, if you're a money vigilance type, your natural caution can help you build a solid financial foundation, but you might also miss out on opportunities because you're too afraid to take risks. On the other hand, if you're a money status type, you might be great at networking and building valuable connections, but you could also fall into the trap of overspending to keep up appearances. Interestingly, couples with different money personalities can actually complement each other. Imagine a partnership between a money vigilance type and a money status type. The cautious partner can help keep spending in check, while the status-oriented partner might encourage the other to enjoy their resources a bit more. It's all about balance and understanding each other's perspectives. So how can you use this knowledge to make better financial decisions? Start by taking some time to reflect on your own attitudes and behaviors around money. There are quizzes and assessments available online that can help you identify your money personality type. Once you have a better understanding of your tendencies, you can start developing strategies that work with your natural inclinations. For example, if you're a money worshiper who tends to spend impulsively, you might benefit from setting up automatic savings transfers or using budgeting apps to help you track your spending. If you're a money avoidance type, you might find it helpful to set small, achievable financial goals to build your confidence and comfort with money matters. Sarah's breakthrough came when she realized that her money personality wasn't something to be ashamed of or try to change completely. Instead, it was a unique part of who she was, something to understand and work with. This shift in perspective was incredibly empowering for her. She started implementing strategies tailored to her specific money personality traits. For her money avoidance tendencies, she began journaling about her financial experiences to help identify and change limiting beliefs about money. To address her money worship inclinations, she practiced delayed gratification techniques, like adding items to a wish list instead of buying them immediately. The payoff of understanding your money personality can be huge. It's like having a roadmap to your financial behaviors. You can anticipate potential pitfalls, leverage your strengths, and make decisions that align with your natural tendencies while still pushing you towards your financial goals. With this final piece of self-knowledge, Sarah felt ready to put it all together. She had learned about smart investing, the power of multiple income streams, and now, the impact of her own money personality on her financial decisions. She was excited to see how this new understanding would shape her financial future. Sarah's financial transformation. Sarah's financial journey took an unexpected turn, and the results were nothing short of remarkable. Let's talk about how challenging those money myths we've discussed changed her financial reality in ways she never imagined possible. Think about it. How much can someone's financial life really improve in just 18 months? For Sarah, the transformation was dramatic. She went from living paycheck to paycheck, drowning in student debt, to feeling confident and in control of her money. But here's the thing, it wasn't about suddenly striking it rich or winning the lottery. Sarah's success came from making smart money moves based on her new understanding of how wealth really works. So, what exactly did Sarah do to implement her new financial knowledge? First, she tackled her emotional spending head-on. By recognizing her triggers and implementing a 24-hour cooling-off period for unplanned purchases, she freed up hundreds of dollars each month. This wasn't just about cutting back. It was about realigning her spending with her true values and goals. Next, Sarah dove into the world of investing. Remember how we talked about the power of starting small? Well, Sarah took that to heart. She began by setting aside just $5 a day, the cost of her daily store-bought coffee. Using a micro-investing app, she automatically invested this small amount into low-cost index funds. It might not sound like much, but over time, this habit could potentially grow into a significant nest egg. But Sarah didn't stop there. She also explored the concept of multiple income streams, drawing inspiration from the fact that many millionaires have 3 or more sources of income. Sarah started a side hustle selling handmade jewelry online. This not only brought in extra cash, but also gave her a creative outlet and boosted her confidence in her ability to generate income. One of the most significant changes Sarah made was in her approach to debt. Instead of viewing all debt as inherently bad, she learned to distinguish between good and bad debt. This new perspective allowed her to make more strategic decisions about her student loans and even consider the possibility of using debt as a tool for future investments. Now, you might be wondering about Sarah's new financial goals and dreams. Well, with her newfound knowledge and confidence, Sarah's aspirations have grown. She's no longer just focused on getting out of debt. She's planning for long-term wealth building. Her goals now include maxing out her retirement accounts, saving for a down payment on a modest home while being mindful not to become house poor, and even starting her own small business in the next 5 years. But Sarah's transformation went beyond just the numbers in her bank account. Her entire relationship with money shifted. She no longer felt anxious or ashamed when thinking about finances. Instead, she felt empowered and excited about the possibilities. Sarah realized that financial freedom wasn't just about having a high income. It was about having the knowledge to make smart decisions with whatever money she had. This shift in mindset had a ripple effect on other areas of Sarah's life. She became more confident at work, negotiating a raise, and taking on new responsibilities. Her personal relationships improved as she felt more secure and less stressed about money. She even started sleeping better at night, knowing she had a solid financial plan in place. One of the most inspiring aspects of Sarah's journey was how she started helping other young women with their money journeys. She began sharing her experiences and newfound knowledge with friends, and soon found herself hosting informal money chats where women could discuss their financial concerns openly. Sarah discovered that by breaking the taboo around money talk, she could help others avoid the same pitfalls she had encountered. Sarah's story shows that with the right knowledge, financial freedom is within reach for everyone. It's not about making millions overnight or having a six-figure salary. It's about understanding how money really works and making informed decisions based on that knowledge. Research indicates that the average time frame for significant financial improvements, such as building a solid emergency fund or paying off debt, can take anywhere from 6 months to 2 years. Sarah's 18-month transformation falls right in line with this timeline, proving that meaningful change is possible within a relatively short period. Moreover, Sarah's journey underscores the importance of financial literacy. Developing a strong financial mindset led to better decision-making and resilience, which are essential for long-term financial health. By setting specific, measurable, achievable, relevant, and time-bound SMART financial goals, Sarah provided herself with clear direction and motivation. Your turn, busting money myths. Now that we've seen Sarah's incredible journey, let's turn the spotlight on you. What if I told you that your own financial transformation could be just around the corner? It's time to take a hard look at the money myths that might be holding you back from your own success story. Think about it. Which financial beliefs have you been carrying around without even realizing it? Maybe you've always thought that investing is only for the wealthy, or that budgeting means giving up everything you enjoy. These are the kind of myths that can keep us stuck in financial limbo, afraid to make moves that could really change our lives. Here's the thing. Busting these money myths isn't just about learning facts. It's about challenging your whole mindset around money. And the good news is you can start this journey today. Let's talk about some simple first steps you can take to question those long-held beliefs. Start by getting curious about your current financial habits. Take a week to really pay attention to how you think and feel about money. When you're about to make a purchase, pause for a moment. Ask yourself, am I buying this because I need it or because of some underlying belief or emotion? This kind of self-reflection can be eye-opening, helping you spot patterns you might never have noticed before. Next, consider setting a clear financial goal for yourself. It doesn't have to be huge. Even something small like saving an extra $50 this month can be a great start. The key is to make it specific and achievable. This gives you a concrete way to measure your progress and starts building your confidence in handling money matters. You might be excited to kick off your own financial transformation story, and you should be. But remember, it's not about making drastic changes overnight. It's about taking small, consistent steps in the right direction. Think about areas where you can start making smart money moves right away. Could you automate a small amount of savings each month? Or maybe you could look into learning about low-cost index funds as a way to dip your toes into investing. Let's talk about resources that can help you continue learning about personal finance. There are so many great books, podcasts, and online courses out there that break down complex money topics into easy-to-understand chunks. Look for ones that resonate with your personal style and goals. And don't be afraid to explore different options. What works for your friend might not be the best fit for you. You might be surprised at how quickly small changes can add up to big results. Remember, every financial decision you make is a chance to reinforce good habits and challenge old beliefs. Even something as simple as questioning whether you really need that impulse purchase can lead to significant savings over time. Finding a supportive community can make a huge difference in your financial journey. Look for local meetups, online forums, or social media groups focused on personal finance. Surrounding yourself with people who share your goals can provide motivation, accountability, and a wealth of shared knowledge. Plus, it's always encouraging to hear stories from others who are on the same path. Here's an exciting thought. You have the power to rewrite your money story. Your financial future isn't set in stone. It's shaped by the decisions you make every day. By questioning money myths and learning to make informed choices, you're opening the door to true financial freedom. Imagine the confidence that comes with knowing you're in control of your financial destiny. Remember, your financial journey is unique. What works for someone else might not be the right fit for you, and that's okay. The important thing is to keep learning, stay curious, and be willing to challenge your assumptions. Everyone has the potential for financial success. It's just a matter of finding the path that works for you. Financial literacy is crucial for overcoming common psychological barriers that can hinder your progress. Things like fear of financial instability or struggling to delay gratification can really hold us back. But the good news is, these are skills we can learn and improve over time. Research shows that people who engage in financial education are more likely to develop better money habits, and those habits lead to improved financial outcomes in the long run. So by taking the time to learn and challenge your beliefs now, you're setting yourself up for a brighter financial future. Let's wrap this up with some real talk about money. You've seen how busting those money myths can be a game changer, right? Here's the thing, financial literacy isn't just about knowing facts, it's about taking action. Studies show that people who understand money are way more likely to save for retirement and invest in the stock market. That's huge. But don't worry if you're not there yet. Everyone's money journey is different, and that's okay. The important part is that you're learning and growing. Maybe you start by taking a free online course or reading a finance book, or perhaps you decide to track your spending for a month. Whatever you choose, remember that small steps can lead to big changes. So, what money myth are you going to tackle first? Think about it. Which one has been holding you back the most? Tackling that could be your first smart money